Are you tired of being nickeled and dimed by the big banks? Well, guess what? I am. In today's financial landscape, the debate of sticking with the traditional big banks or moving to no-cost banking is more relevant than ever. In today's video, I'm going to share with you my experience with my big bank and what changes I'll be making to my banking in the near future. But before we do that, as always, we're going to jump into my portfolio. We're going to have a look at how it's performing. We're going to buy some stocks, and we're going to see what kind of dividends we've earned since the last video that I posted. My name's Darren. This is the Crazy Canuck Investor, where I try to make investing a little bit easier for beginners. Let's face it, there's no magic that makes you ready for day one of investing. And I'm going to help you out by sharing my journey with all the ups and downs along the way. So without further ado, let's jump right into the portfolio and see how things are doing. My entire portfolio is $138,088. Now my account is comprised of 4 separate accounts, and we're going to break down each of those accounts. So the first account is my cash account. That's held with Wealthsimple, and I earn 4.5% interest on this account, and it's currently sitting at $35,535. Now just to explain things, if you're just starting out, it's really important before you start investing that you have an emergency fund set aside. So this account holds that emergency fund. So let's say my wife or myself was to lose my job, then we would be able to pay for our day-to-day expenses that may come up in that type of an emergency. Now it's also our savings account, which is why there's some extra money in there. We are looking to do some things down the road, and that's why we're keeping fluid cash available to do those types of things. So as of today, that account has earned me $134.57 in the month of March, and it'll get paid out tomorrow. I'm recording on March the 31st. And what I do with that, because it is taxable interest, I take that money and then I put it over into my spousal account to offset the extra money that's earned. Now, if you do the math on it, it works out to be around $1,300 to $1,400 annually on the current amount that I'm holding. But every little bit helps to offset because I do make a little bit more money than my wife. So we're going to send that over to this spousal account. She'll withdraw that later in life and get taxed a little bit lower bracket. So overall, we're saving a little bit extra money. So one feature that I really like about Wealthsimple's cash account is that they have their own rewards program. Now, Wealthsimple is growing and adding new features all of the time. Now, this particular one is a 1% cashback, and that cashback can be used for trading. Now, it's not like a traditional credit card where you would get 1% back and then be able to spend that money on, say, travel rewards or groceries or that type of thing. Instead, the money is directly deposited into your trading account. Okay, so we're going to jump over to our kids' RESP, or Registered Education Savings Plan. That account currently is holding $61,647. Now, something that's important to note, I do tell you in the intro that I'm sharing all the ups and downs. And if you haven't been following me, one of the things that I like to tell people is it's important to get your money working early. I made that mistake early on. We set a lot of money aside when we opened this account. We took advantage of the government grants, which is really important. And I did make a video on RRSP, so if you haven't seen it, you should check it out. It explains a lot more. But we didn't invest that money, and we lost out on a lot of compounding interest over time. Now, the good news is we're invested now, and I'm sharing this with other people in the hopes that you don't make that mistake that I did. Now, this account is a managed account. We do pay fees for it every month, but at this point, Wealthsimple doesn't offer an account where I can look after it. And you know what? My time's important as well. So by managing the other accounts, I have freed up because Wealthsimple will look after this account for me. And I think your time is definitely worth a little bit of investment for the amount that they do charge. And that amount is actually reduced because we are premium customers as well. So what I like about Wealthsimple is that they tell you what they're doing with the account over time and what that will look like at the time that you want to withdraw the money. And in our case, that money is going to grow. As you can see, they're estimating that the value of that account will be $238,000. And like I said, I did make a video about RESPs, and I talk about what the implications of that money are down the road if you were to withdraw it, and so on and so forth. So please go check that video out. So this account right now is performing really well. In fact, it's performing the best of all of my accounts. So right now it's up 13%, which is roughly $7,400. And we've been investing for the last year. We're just coming up on the anniversary of opening the account, which was in April of 2023. So I'm really pleased with the performance of this account, and I can only assume that we'll continue to perform fairly well in the future. On the average, of course, because you're going to have ups and downs. There's not always going to be great days like this where the screen looks green, where everything's positive. There will be down days. But on average, I suspect this account will perform fairly well. So since the last video that I posted, we make regular contributions, and that's $200. So it's $100 for our son and $100 for our daughter, and it's broken up within the account. You assign that. And since those deposits were made, that money was invested into EEMV. And if you're not sure what that ETF's all about, I would definitely recommend to go check it out. Then they also invested in QCN. Again, this isn't me. This is a robo advisor that's doing this on our behalf, and that's what we pay for. So they invested in QCN and they invested in QUU. And it has to do with asset allocation. So they're allocating certain amounts to various ETFs. And you're not sure what asset allocation is, I also made a video about it. You should go check that out. It kind of explains things. You can see here that we got dinged $3.35 for the non-residence tax. That's because some of the funds that we're investing in are in the US, and as a result of not being US citizens and it not being in your RRSP, you do get charged fees. That's just the nature of the game. But given the small amount and the growth of this account, I really don't think that it's a concern. The last thing is that we got a dividend of $22.29 from GLOV. And of course, then that was then reinvested back into the account. So my RRSP is up to $16,765. The one-day performance on that is up $69. Over the week, it's up $153. Over the last month, it's up $279. Over the last 3 months, it's up $1,008. So performing really well. That's about 6%. And all time, this account is up $1,808, which equates to 12%. So all in all, the markets are doing really well. And so this account is performing fairly well. But I have gone back and looked at some of my previous videos when I first started out, and not every day is like that. There is one video that I did that is pretty dreadful, where I talk about red days and what you might experience when the markets aren't doing well. And you have to keep in mind that markets are going to go up and down depending on various influencing factors, whether it just be the news or what's going on locally or whatever the case may be. So you can expect average returns, but they're not always going to be as amazing as you see at 12%. Statistically, I think averaging somewhere between 5 and 10% is probably fairly realistic returns, some years better than others. If you don't know, I'm on Blossom, and Blossom Social is a great app that is designed to allow investors to share ideas, to share their portfolios, and just generally talk about investing ideas, some of which can be incredibly hot topics from time to time or create some incredibly great conversations. I mention this because when you look at my Blossom profile, if you go check me out over there, you're going to see that both my TFSA and my RRSP are the two accounts that you're seeing at the same time, but when I do my videos, I break them down and talk about them individually. But I manage them together for a couple of reasons. For instance, you don't want to hold US equities in your TFSA, rather you should be holding them in your RRSP, and that's to maximize your returns so you don't get dinged on the 15% dividend tax as a non-resident that I showed you in my RRSP. So the goal would be to hold any US listed dividend paying stocks in your RRSP in a US account. Now, recently, I introduced a new ETF into my RRSP, which I'm going to try and have an asset allocation held between my TFSA and my RRSP, almost like managing them together. So that ETF is AVDV. Now, I only used some of the dividends that I had earned, which only bought me 0.5 of a share, but I plan to expand that over time. And I'll talk a little bit about what AVDV is. What is AVDV? AVDV invests in a broad set of non-US developed small cap companies and is designed to increase expected returns by focusing on firms believed to be trading at low valuations with higher profitability ratios. Now, why do I want to do something like this? Well, let's say that the markets are doing really strong with stocks like Amazon or some of the big seven that you may know. Is their future returns going to be really strong for what you're paying for those stocks right now? Maybe, maybe not. So by investing in some smaller companies with potential for growth, that diversifies my portfolio and potentially has higher expected returns. Now, it is a bit riskier because these companies are not necessarily as well established as, say, the bigger companies in the S&P 500, for instance. But I'm willing to take this risk because I think it might pay off over time. So here we can see some of the countries that this particular ETF invests in: Japan, United Kingdom, Australia, Canada, Sweden, and so on and so forth. And like I said, these are small cap companies. Okay, so we're gonna have a look at the dividends and some of the stocks that I bought in my RRSP since the last video that I posted. So since then, Manulife's paid out $7.20, and VRE, which is a ETF of REITs, paid out 47 cents. It is a fairly small part of my holding, but that is part of my asset allocation. I don't want to hold way too many of the REITs, so I'm keeping that fairly low right now. And I'm still in that accumulation phase because I don't have a lot of money in these accounts yet. So right now the returns are fairly small, but they will continue to grow over time. So VRE paid out 47 cents. XIC paid out $5.87, and XEI paid out $11.91, and Canadian National Railway paid out $5.92. So we have $23.70 in dividends that are in Canadian funds in my RRSP. And what we're going to do is we're going to invest that into XIC, which is the Canadian stock market, the entire Canadian stock market. So I don't have enough to buy a full share, so we're going to be making a fractional buy. And of course, I'm making this purchase on the weekend, so this will go through on the next day, on the next trading day. So while I continue to diversify my portfolio, just in review, in my RRSP, I bought 0.5 shares of AVDV, which is that small cap ETF, gives me that broad diversification. And we also bought a fractional share of XIC, which is the entire Canadian stock market. All right, jumping over to my TFSA, which is the account that I do highlight along with my RRSP on this channel. I'm trying to max out that TFSA. And I also have built up an asset allocation, and we're going to jump over and have a quick look at that before we talk about the entire account. But the account is at $23,975. So let's jump over to passive. We'll have a quick look at my asset allocation. So if you're not familiar with passive, I did make a video on it. Go check it out if you want. It explains how to use passive. But passive's a great tool for tracking your dividends, the stocks that you're buying, but more importantly is your asset allocation. Asset allocation is very important to managing your entire portfolio. And I've gone in manually and set my asset allocation. You can see as you look at the screen here, we're going to be buying two ETFs today. One is XEF and the other one is XIC. I've already talked about XIC, which was the Canadian stock market, or the entire Canadian stock market. And the other one is XEF, which is international diversification. If you watched my last video, we bought some shares of it then, and we're going to continue to do that. The goal is to have 15% of this portfolio in XEF, and we're working towards that. And then with XIC, we're working to have 8% of that in XIC. And if you're wondering why it's lower because the entire Canadian stock market is a small percentage of international diversification. So I don't want to really overweight myself. Having some home country bias, I suppose, is a good thing. And if you look at some of the things that I hold within my portfolio, you'll see that I do lean towards Canadian home bias a little bit, but I'm going to try to manage that through my asset allocation. So right now we're aiming for 8% of XIC, and we're balancing that with 8% of XEI. And then you saw that in my RRSP, I hold a percentage over there as well. And as I said, I'm managing them together when I look at my entire asset allocation. Okay, so let's look at the performance. So as I said before, not every day is going to be great. Not every day is going to be green, as it were. There are days when things are looking red, and the one-day performance on this account, it's down $990. Over the week, it's up $106. Over the month, there's no change at all. And the all-time returns on this account, it's up 11%, which is about $2,500. So again, it's looking fairly good as far as performance goes right now, which I'm really pleased with. And keep in mind, I am a DIY beginner investor. I've done all of this on my own. Do I think it's going to be like this every day? Of course not. Things will change. There's going to be days when this account will probably be down, but I'm in it for the long haul. Retirement's at least 10 years away, and withdrawing all of this money won't occur right away, so this money will continue to grow over time. So I do have my stock lending turn on. Simplicity, what's that? I'm basically loaning some stocks out to other people that want to use them for other investing strategies, and it's not paying a great deal. The first month I earned, I think it was 1 or 2 cents. The second month was about 3 cents, and it looks like coming up, as you can see, on the next payday of April 12th, I'll earn a whopping 4 cents. But it's growing each month. It's growing, so I assume as I build that account up, it'll be returning money. And I guess you could call that passive money return because I'm not doing anything. Those stocks are sitting in my account. Now the downside is that I can't have any voting rights for whatever stock I might be holding. But I can get the dividends still paid to me for those. They are through a synthetic dividend. And I think some of them will show up when I show you the history from the last video that I posted. Okay, so we'll take a quick look at what's happened since the last video. So the first thing was stock lending. You can see there on March 17th, I earned a whopping 1 cent. But again, I didn't really have to do anything for earning that kind of money, so why not? The second one was on March 24th, VRE, which is the ETF that holds REITs, paid out $2.19. Now in my TFSA, I hold more of VRE than I do in my RRSP, but it's still a very small percentage. That's why the dividend is fairly small. The next thing we're going to look at is what we bought this week. So we bought 18 shares of XEF, which total about $674. And then the next thing that we bought was 7 shares of XIC, and that's helping build up that asset allocation that I was talking about. So jumping over to passive, now that we've made those purchases, you can see that our asset allocation of XEF is now 10%. So we're really closing in on that 15% asset allocation. So once we reach that, then we'll be maintaining that. And the beauty of passive is that it will make suggestions based on the amount of money that you input into your account in order to buy certain stocks or ETFs to keep you in line with that asset allocation. And the other one is XIC, and right now we're at 4.4% of the 8 that we're shooting for. So we're basically halfway there. Okay, now back over to what's taken place. The last thing that I did was I didn't want to stay away from all single stock positions. So one of the stocks that I have been holding since I opened my account is TELUS. Now we're TELUS customers. I would consider this more of a defensive position because I don't think that it has the performance per se that say a strong stock like, I don't know, Amazon might perform. But it pays a decent dividend. And as you can see in my account, it's down 8%. So I would consider this a bit of a discount to buy this stock. So rather than put it into something that's say like BAM, which is up 21%, I'm going to buy some TELUS stocks. So this week I bought 5 shares of TELUS, and obviously we're going to continue to grow these single stock positions, but I am going to keep the single stock positions a very small percentage of my portfolio. We're working towards more broad-based ETFs, but I am going to keep these, and as I learn more, I'll probably be introducing some other single stock positions once I learn how to properly evaluate those positions. And we got XIC paid a dividend of $1.79 and XEI paid $10.68. And you can see up here there's a manufactured dividend. That's as a result of those stocks that were on loan. It doesn't specify when you look at it, but let's say those were TELUS shares, then it is going, then Wealthsimple then puts in this manufactured dividend to ensure that you get the dividend that your stock would normally have paid out. And last but not least, we had a little bit of money left over, which is not enough to buy a full share of pretty much anything. So I always put that into QQC, and that was a fractional buy of $2.25. So in the beginning of the video, I told you that I basically wasn't very happy with my bank. That bank is TD. It's definitely one of the big banks. Full disclosure, I do hold a position in TD, and I hold it in a lot of our accounts, not just in the ones that I'm featuring on my channel. However, being a customer with TD does come with some downside. And since I started investing, I've learned that budgeting hacks or budgeting tricks are really important to help you grow your portfolio or your investable amount of money. Because let's face it, unless you have another job or another way to go out and make some extra money, you have to figure out ways to trim some of the fees and whatnot that you currently have with various accounts and so on and so forth. So in this case, I'll tell you a little bit about my TD account and then my experience that I had with TD. So a good practice to get into is to look at different fees that you're paying in your various accounts. For instance, you might go over your bank statement and see that perhaps you're paying for subscriptions for things that you're not using, and then look at ways to either eliminate or reduce those, and then take that money and go and invest it in this. So we have what's called the all-inclusive banking plan with Toronto Dominion, and I'm just going to break it down a little bit so you have an appreciation for what this account is all about, and then we'll talk about what I tried to do with it and what I'm going to do in the future. So the account itself requires you to maintain a balance of $5,000 every month. So if you drop down below $5,000, they're going to charge you a fee of $30. Now, what do you get for maintaining this balance or paying the $30? Well, you get unlimited transactions. So basically, there's nothing you're going to get charged for with respect to your banking. Now, there are a couple other benefits which are important to take note of. So the first of which is you get the TD First Class Travel Credit Card. Now, if you were to go out and get this credit card on your own without having this particular bank account with TD, the first credit card is going to cost you $139 for annual fee, and then an additional card would cost you $50. So my card would say $139, and if I wanted my wife to have one, that would be an additional $50. Now, what do you get with this thing that's so great about it? Well, it's a very diverse card, and we've been using it for a long time. So we charge all of our different expenditures throughout the month on the card, and by doing so, we get points. Unlike a lot of travel reward programs, these points can be used in any way to pay for any travel, and they give you a bonus if you actually use it with Expedia. And TD has an agreement with Expedia. It's a special Expedia site just for people that hold this particular credit card. Now, we've used it a number of times to pay for trips. That's typically what we use it for. It generally pays for our airfare before we go to the location that we're going to, and then obviously we're paying for a hotel when we get there. Now, it does come with a lot of other travel benefits, which include insurance, trip interruption, and so on and so forth. So in general, it's a very good credit card for all of the features that it offers. But the real question is it a good credit card when I have to pay for it? So going back to the select service account or the all-inclusive account, well, I'm getting all these great unlimited transaction fees. Am I really using them? The other thing that you get with your account is you get a safety deposit box. Well, we actually don't use it. We have another way of securing all our important documents, and that's obviously something to think of, because when it comes to investing, you want to make sure you have a will in place, and if you don't, you should probably give that some consideration. But with us, this TD account doesn't really meet our needs anymore. And now that we're using Wealthsimple, as I told you, Wealthsimple offers 4.5% interest. Think of the cash account like the TD Bank account that we're currently using. It's all inclusive. I can make all of my payments for my various bills through our cash account, including our mortgage. Now, if you direct deposit your paycheck, as you can see here on the screen, into your cash account, they're going to increase that amount by 0.5%. So in total, I would be getting 5% interest on any money that sits in that cash account. And so I'm struggling with paying TD $30 a month because $5,000 sitting in that TD account is not earning any interest. And if I go below $5,000, they charge me $30. And when you do the math on that, that adds up to $360 annually. That's a lot of money, especially if you compound that over time. So what I did is I went to the bank and I inquired with them as to whether or not they could reduce or remove that fee. Now, through my conversation with the person at the bank, I explained to them what I was interested in and why I was interested in it. And I told them up front that I was going to be willing to leave the bank if they were not willing to help me. But I was willing to listen to anything they had to say or any offers that they might have. And I've been with TD, my wife and I have been with TD since 1991. So we've been loyal customers to them for a really long time. We've held a number of mortgages with them. We've definitely done all our banking with them. And sadly, at the end of the conversation, the representative, who was very polite, he came back and told us that the bank was not willing to waive any of those fees at all. And of course, there's other alternatives out there like the Wealthsimple cash account, as well as EQ Bank. EQ Bank offers no fee banking as well, and they also offer an interest rate on money that sits in your account. So I'm left with the dilemma of what to do now. And none of the features of this account are really going to keep me with TD. So I've made the decision to move on from TD, even after being a customer with them since 1991. So moving forward, I'm going to be transitioning over to the Wealthsimple cash account, and I'll be having my paychecks directly deposited as well as my wife's into those accounts. Now, it will take me a little time to set it up, and I have to work through some logistics with the credit card because we have points sitting on that credit card. But even the fees for 1 year are far less than what TD is charging us on the account. And the cash account with Wealthsimple is in the beta testing phase to have checks as well. So really, there's nothing holding me back from jumping over to Wealthsimple and doing all of my banking there. So stay tuned for that in the near future.